We all want to see our money grow, to see our hard work and savings flourish over time. Putting your hard-earned cash to work effectively is key to achieving your financial dreams. It's about making smart choices and planning for the future. Whether it's saving for a down payment on a house, your child's education, or even a dream vacation or a comfortable retirement, investing is essential. It's about securing your future and ensuring peace of mind. But the world of investing can seem daunting, especially for beginners. The sheer number of options and the complexity can be overwhelming. That's where mutual funds come in, offering a simple and accessible way to participate in the financial markets. They simplify the process and make it more approachable. Mutual funds are like baskets of stocks or bonds. They gather a variety of investments into one package. They allow you to invest in a diversified portfolio of assets without having to pick and choose every single one yourself. This diversification helps manage risk. Think of it as teamwork for your money. By pooling resources, you can achieve more together. By pooling your money with other investors, mutual funds give you access to a wider range of investments than you might be able to afford on your own. This collective approach opens up more opportunities. They also provide professional management, making them a convenient option for investors of all levels of experience. This professional oversight can help optimize your returns. In this essay, we'll demystify mutual funds and empower you to make informed investment decisions. Knowledge is power, and understanding your options is the first step. We'll cover the basics from different types of funds to the costs and risks involved. This comprehensive overview will give you the confidence to invest wisely. Let's get started on your journey to financial success. Together, we can make your money work harder for you. Imagine you and your friends want to buy a large pizza. It's too expensive for any one of you to buy alone. But if you all chip in a few dollars, you can share the cost and enjoy the pizza together. That's the basic idea behind a mutual fund. A mutual fund is an investment vehicle that pools money from many investors to purchase a diversified portfolio of assets, such as stocks, bonds, or other securities. Each investor in the fund owns shares, which represent a portion of the fund's holdings. When you invest in a mutual fund, you are buying a piece of that diversified portfolio. Mutual funds are managed by professional fund managers. These experts use their knowledge and experience to select the investments within the fund's portfolio. They aim to achieve the fund's investment objectives, which could be growth, income, or a combination of both. Just like there are different flavors of pizza to suit every taste, there are various types of mutual funds designed to meet different investment goals. Let's explore some of the most common types. Equity funds invest primarily in stocks. They offer the potential for high growth but also come with higher risk. Bond funds invest in bonds, which are less risky than stocks, but generally offer lower returns. They are a good option for investors seeking regular income. Money market funds invest in short-term debt securities. They offer stability and liquidity, making them suitable for emergency funds or short-term savings goals. Balanced funds invest in a mix of stocks and bonds. They aim to provide a balance of growth and income. Index funds track a specific market index, such as the S&P 500. They offer broad market exposure at a low cost. By understanding the different types of mutual funds, you can choose the ones that align with your investment goals, risk tolerance, and time horizon. Section 4. Building a strong portfolio, diversification, and asset allocation. You've probably heard the saying, "Don't put all your eggs in one basket." This age-old wisdom holds true in the world of investing as well. Diversification is key to managing risk and building a resilient investment portfolio. Diversification simply means spreading your investments across different asset classes, such as stocks, bonds, and real estate. It also means investing in different sectors within each asset class. For example, within stocks, you might invest in technology, healthcare, and energy companies. Asset allocation refers to the proportion of your portfolio that you allocate to each asset class. The right asset allocation for you will depend on your risk tolerance, time horizon, and financial goals. By diversifying your portfolio and choosing an appropriate asset allocation strategy, you can reduce the impact of any single investment on your overall portfolio. Section 5. The price of investing. Understanding mutual fund costs. Like any other service, investing in mutual funds comes with costs. These costs can vary significantly depending on the type of fund and the management style. It's important to understand these costs so you can make informed decisions about where to invest your money. Being aware of the fees can help you choose funds that align with your financial goals. One of the main costs associated with mutual funds is the expense ratio. This fee covers the operational costs of the fund, including management fees, administrative fees, and other expenses. The expense ratio is an annual fee charged by the fund company to cover the costs of managing the fund. It is deducted from the fund's assets, which can impact your overall returns. It is expressed as a percentage of your investment. For example, a 1% expense ratio means that for every $1,000 invested, $10 per year will go towards covering these costs. Another cost to consider is the sales load. This is a commission paid to the broker or financial advisor who sells you the fund. Some mutual funds charge a sales load, which is a commission paid to the broker or financial advisor who sells you the fund. This can be a significant cost, especially for large investments. Load funds can be front-end loads, meaning you pay the commission when you buy the fund, or back-end loads, meaning you pay when you sell. Understanding when and how these fees are charged is crucial. In addition to these explicit costs, there are also hidden costs associated with mutual funds, such as trading costs and taxes. These can add up over time and reduce your overall returns. By carefully considering the costs involved, you can minimize your expenses and maximize your returns over the long run. Being an informed investor is key to achieving your financial goals. Section 6. Navigating the water's risks associated with mutual funds. Investing in mutual funds involves risks, just like any other investment. While diversification can help mitigate some risks, it's essential to understand the potential downsides before investing in mutual funds. Market risk is the risk that the overall stock market will decline, causing your mutual fund investments to lose value. Interest rate risk is the risk that rising interest rates will cause the value of bond funds to decline significantly. Credit risk is the risk that a bond issuer will default on its debt payments, potentially leading to losses in bond funds. It's important to remember that past performance is not necessarily indicative of future results in the market. The value of your investments can go down as well as up, depending on market conditions. However, by understanding the risks involved and investing for the long term, you can increase your chances of success. Section 7. Measuring success. Evaluating mutual fund performance. Once you've invested in mutual funds, it's essential to track their performance and ensure they are meeting your investment objectives. Regularly monitoring your investments helps you stay informed and make necessary adjustments to your portfolio. But how do you evaluate the performance of a mutual fund? One way is to compare the fund's returns to a benchmark, such as a relevant stock market index. This comparison helps you understand if the fund is performing well relative to the broader market. For example, if you invest in a large-cap stock fund, you might compare its performance to the S&P 500 index. This can give you a clear picture of how your fund is doing compared to similar investments. You should also consider the fund's risk-adjusted returns. This metric provides insight into how much risk the fund is taking to achieve its returns. A fund might have high returns, but also high volatility, which means your investment could experience significant fluctuations in value. Understanding this can help you manage your expectations and risk tolerance. Risk-adjusted return measures take into account both the returns and the risk of an investment. This helps you evaluate whether the returns justify the level of risk taken. Remember that past performance is not a guarantee of future results. Market conditions and other factors can change, affecting future performance. However, by tracking performance and evaluating a fund's track record, you can get a better understanding of how it might perform in the future. This historical data can be a useful tool in making informed investment decisions. Investing can be a powerful tool for building wealth and achieving your financial goals. With careful planning and regular evaluation, you can maximize the potential of your investments. Mutual funds offer a convenient and accessible way to participate in the financial markets and benefit from professional management. They provide diversification and professional oversight, which can be particularly beneficial for individual investors. By understanding the basics of mutual funds, you can make informed decisions and start investing for your future today. Knowledge is power, and being well informed can help you achieve your financial aspirations.